And we're live, and we're delighted to welcome to Benny and the Squirrel, John JJ slash Alyosha Johnston, a veteran trader of the metals market. He had his own seat in the COMEX when I was in short trousers and when Ben wasn't even born. So we are going to learn a ton, and we're really looking forward to a masterclass. Welcome, JJ.
Thank you, Rupert. Pleasure to be here. Hi, Benny.
Hey, thanks for joining us, buddy.
Listen, JJ, we're going to cut straight to the chase. What on earth is going on in the silver market right now? It's been quite an adventure, and I'm using your charts just so that you don't get any of my lousy ones.
Okay, so the first thing that comes to mind is it's pretty much over. It's that chapter is over. It started
as in the squeeze, as in the Christmas squeeze. That game.
The Christmas squeeze was like the last 5 paragraphs of what had been an epic story of an evolving silver market that has its own special DNA, and you can take it back to the squeezes that we had in the past, beginning in 1980, the Buffett squeeze in 97, 98, then the Chinese squeeze in 2011, went to 50 again. The Reddit squeeze in 2021, and now this squeeze. So silver is unique in that has been paired with gold for 3,000 years. It's had periodic eras when it was money, and back and forth, the cross of gold and Jennings Bryan and all of that stuff. But it's not gold. It's significantly smaller. I would say, comparing the two in market cap and supply and industry and everything, it would be like a golf ball to a basketball, or Mercury to Venus. Not Venus, well, maybe. That's a little too big. But emotionally, the market views silver as a kind of gold, and there's not enough of it when everybody wants it, and there's just too much of it when they decide, well, we're done with it. And that usually happens after these episodic blow-offs, which we've just seen. So, you have to have that in your mind. The fundamental side of it is really very interesting. If you go back to the beginning of time, when we started using precious metals as money, we've mined a total of about 56 billion tons. And over time, particularly in the 20th century, when it became a strategic metal, chemical processes, photographic, things like that, there was, severe attrition of above ground stocks. So today, there's only about 19 billion tons left of that genesis to present stock that has been worn down in the last, say, 75 years. Most of that is in heirlooms in India that you mentioned earlier, and Asia, which will never be sold. There might be a secondary, let's call that tertiary supply, secondary supply, beyond what we would have, that can be readily mobilized in exchange inventories in Shanghai, London, and New York, and so forth. There might be another billion, maybe, I don't know, but you have to have high enough prices to mobilize it, like now. So the big question, and I'll wind up quickly so we can move along. The big question in silver right now is how much of that secondary supply, fork, spoons, Tiffany, Buccellati, which, is going in at melt. We're talking fine silver, Reed and Barton, beautiful flatware, Caldwell, works of art that have been hauled in oil drums and gone to refineries in such volume that, as they said, that's it. We're not taking any more, and we're not pricing any metal coming in. We will get to it, refine it, and when we do, we'll tell you what we're gonna pay you. So there's a lot of unknowns. As you know, industrial demand is growing. new uses in the industry for silver that we never knew about before are starting to really rise, and the available supply is still extremely tight. So I'm not. What we don't have. This is what we don't have is the squeeze was the last of a glut of paper supply. And when you look at futures, we'll talk about this when we get to oil, paper supply equals metal, period. I want to go in and I want to sell 2,000 March. That's metal until the claims on it fail and the connection between paper and metal breaks. We saw that in January 2025 when the Bank of England had I don't know what to call it. I say it's a default. If you have 10 tons of gold at the Bank of England on deposit in a custodial agreement, and they say, well, you can't have it. We don't have it. Gold people don't like that.
I mean, isn't that kind of what happened after like Nixon ended the peg? I always like to say that was a default. Like they're like, hey, you know what? We used to convert gold, now we don't anymore. That's a bit of a default, right?
Yeah, so they called it a pause, and they had to wait for scrap to go through the system and come out and create new bars, and it started in January, and so by March. What is that? This is like 12 weeks later. The lease rates started coming down in London and it all relaxed. And everybody said, don't worry about it, And so right now, that's where we are in silver. We're waiting to see how many new bars are going to come out of the global refinery system, out of the pipeline. And, since it's taken so long, it's going to take quite a while before we're going to actually normalize everything.
Yeah. So let's go to where you read the tape right now. And actually, what I'm really looking for is you use these wonderful old school compression charts, and I'd love a bit of a masterclass on how to read them and specifically what you're seeing in that silver tape right now. And this is the March contract, right?
Yeah. Okay. So what this is what's the date there? The second. So it's about 20 sessions. That all I do is I left click on my mouse on that profile of today. I drag it across and I compress it with yesterday. Compress that with the day before, the day before, the day before. So this is a profile of the month of February, and where you see those lines going across, those are points of control, or what Stottlemyre, who was a genius who invented this, would call a high time price opportunity, HTPOs. And the reason why I identify those is because it's the most actively traded price in the sample. This is where the majority of all trades done in that period of time have been located. Why is that important? Because when it moves away from it, that's where all the losers are located. And, if you're long and it's going your way, you're playing golf. You wonder what the poor people are doing, right? If you're short, you must act. And that drives price. So the more potential energy as that extends out over, I don't know how many sessions, that you build, the more powerful when it becomes kinetic. Shorts start covering, price starts going up, longs start getting interested. You have new longs coming in, shorts trying to cover. There's a lot of competition for offers. It's like 20 guys and one girl at a dance, right? There's no, and it just goes. So, knowing.
When you look at this, JJ, when you look at this, does your mental model go back to an open outcry pit, and you're almost picturing the faces around the ring and how they're positioned?
No. I do that when I'm writing, but this is a kind of a modern construct. It's something that so in the mid 80s, when we started having a lot of new things going on, like prior to, I would say, even 1990, well, 88 maybe, we didn't have any Bloomberg. Bloomberg started in 84, but he was nowhere. There was no FOMC, there was no BLS, there was no non-farm payroll. There was really no other information than, put it in a different way, I think, than price, right? So in those days, price moved first. You go up $10 in gold, everybody calls you and they say, what's going on? You say, well, Goldman came in, they bought this, that, and the other thing. So then rumors would come down to the floor, we'd react to them, stops were hit, locals are long, that kind of thing. That was the kind of information. So after price moved, you would begin to get narratives created around price. And that, would sort of fill in the information void. Today, you have a kind of a narrative factory that they put out there, and they use prices to validate their narratives, right? So the BLS, I don't know, pick anything, non-farm payroll comes in and, a tick up or a tick down, wages move a little bit, CPI is by a tenth or something like that. And all of a sudden, boom, massive volume comes in and the S&Ps rally 50 handles. So those 50 handles are validating the BLS information rather than moving 50 handles and having a piece of information about why it's happening. There's a very, very big difference about what's happening in the markets today. So the thing that's great about the profile is it's non-time sensitive. So you have a lot of indicators like RSIs, stochastics, and moving averages and things like that, which are time sensitive, and they have no value until you look at them after settlement. Because what would happen if you took a moving average signal in the middle of the session and the market went down, you'd be long against signal, right? So non-time sensitive indicators like Willis-Welders, DMI, and Solomon's market profile are live. In other words, if you take a trade based on what you're seeing there, it's not going to change. That indicator is going to stay with you and develop through your trade, or, at least it won't invert on you during the session where you've actually taken it. So anyway,
when you were actually trading it, obviously you didn't have the benefit of the market profile and these compression charts when you were there.
Right.
It was just memory and presence that had you registering where the active price was, where what we now call the point of control?
Yeah, I gave a speech on this. This is kind of wonky, but I'm sure you'll be able to relate to it. When you have nothing else, you have a sixth sense, which, in our time, young people don't have. And that's a sense of value. When you see something in a backyard auction, and, maybe it's a beautiful bicycle or some plates or something like that, immediately when you see it going, do I have 5, do I have 10, 50 or something like that, your sense of value is going to say, I'll pay 70 for that, right? You want it at that price. Well, the same thing is true if you're trading without information, anything, gold, silver, like we always had a sense of value, and there were markers in the pit where you would see volume trading on the lows or on the highs, and we could identify those points and trade around them. So, when we had the profile to graphically express that, it became a really useful tool.
And when did that come into play? When did you first be able to get one of those real time? Late 80s?
In 88, a couple guys from Revco were doing it in the pit, and I said, hey, what's that? And I said, well, that's great and everything. So all the locals got together and we all chipped in some money, and we called Pete and we said, hey, what do you want to come out here and teach a class? And he said, I'll come for, you pay my hotel, and so for $5,000, I'll do a class of any size you want. So about 20 of us flew him out to New York. And, he's this one of a kind.
Wow, it's genius. It's genius. Just before we move off silver, I just have a quick question. It's all of these curious exchange halts that we're going through right now, and you know, I snipped over the top where you wrote yesterday, yeah, the episode in silver is over. It's time to move on to the next one.
Yeah.
To what? I mean, that's the second of these somewhat suspicious exchange halts recently. What are we to make of them?
Well, they're definitely doing something. You know, this is the CME is multi redundancies, lots of backups, lots of geniuses, that kind of thing. But what I think happened here, because of the way the market behaved, the surveillance people are constantly in touch, you know, with exigent positions from the beginning of the cycle, probably as early as the first week of February, getting a sense of intentions of the people and the FCMs that are holding them. You know, I'm taking a sip of water here. The CME is not responsible for performance of this stuff. They just provide the platform. The clearing corporation, which is the community of FCMs, and that's all the banks and all the, I guess, the investor houses, of which there aren't that many. You know, there'd be StoneX and ADM Investor Services and so forth. They are responsible if there's a default.
Mm-hmm.
And so it's not just, you know, JP Morgan or someone else, you know, some big shot in China with a position there. The whole community is deeply interested in what the fuck is happening, because it's a lot of money, you know, if things go wrong. So that there's a process of transparency within them where everybody's informed about who's holding what and how bad or how big it is, to the extent that they can protect the integrity of anonymity and that kind of thing, but not that much. You know, the exchanges are very aggressive about keeping an eye on things. So what I think happened, knowing what was going on, is they called a halt 20 minutes before settlement. You know, silver settles at 1:30, and it was like 12:11 Chicago time. And then they restarted about a half an hour after settlement, which meant whatever was going on with settlement, there was some silver there, which they either would have had to liquidate on the close or let it pass settlement, right? So gave them an extra 24 hours to move it, adjust it, whatever. That's my only insight on that, is that it happened at settlement. And settlement, as you know, that's the price at which delivers are made and paid, right?
Yeah.
And that's all happening now. Yes,
yeah.
ma'am.
It kind of reminds me. I'm not as familiar with that group as I am with the Option Clearing Corporation, which is kind of the equivalent in the options world of, you know, a bunch of members, and they protect themselves, and there's a lot of leverage that comes out of that. And Rupert and I talk about it a lot, and I talk about options volatility a lot. You see a lot of shenanigans around option expiration as well. It's kind of a similar kind of concept, maybe not as much in futures as you do in options, but like it's actually funny. I never thought about that with futures as much. And so you think that the preservation of the exchange and the clearing mechanism, you know, guys will just do what they need to do. Is that more or less what I'm hearing from you?
These are smart guys, you know, and there are
Yeah.
a lot of them. They probably looked at it and said reputation risk is much lower for a halt than it is for a default, right?
Yeah.
And you know, it's silver is just in a very unique position here right now, where everybody's gone way, way over their skis. I saw something really interesting in Bloomberg the other day. Jamie Dimon said, he made it, I think it was a careless remark. He said, our trading revenues are going to be bigger for Q1 2026 than they were in Q1 2025. And they earned $9.7 billion in Q1 2025. And he excused that shameful, vulgar amount of profit by saying volatility gave it to us, right? Well, there are only two markets that were volatile in Q1. One was silver, the other was gold. So for all of the, quacking about JPM being short and rigging the market and everything, they were obviously massively long.
Yeah. I was listening to Alex Gorevich, who was on the Market Huddle, our mutual friend Kevin Muir's show the other day, and he was on the management committee, the securities management committee at JP Morgan, and said, all this conspiracy about the massive gold and silver shorts at JP Morgan, I think I would have heard about it where I was sitting for a lot of my career.
Yeah, exactly.
So when you say that the silver trade is over for now, I know you're not big on making longer term price predictions. That's not what you do. But do you think it's a correction in time here, or we've got to see lower prices?
Well, okay, you're maybe misunderstanding the context. I'm saying that the big short is gone.
Okay, understood.
There's no more mad gamma. There's no more desperation to lease silver at like incredible screaming rates or anything like that. So we're that is over, and we may see it again in another 10 years or 5 years or 20 years. I don't know, but that part of silver is over. What we're left with is a very small amount of silver, a very well-educated public that likes the idea of silver now because gold is $5,000 an ounce, right? And it's still, growing into this new role in the metal sector, where it's nothing's. That part is not over. That part is just beginning. So
yeah, and I think that's a very important distinction, and I talk about that a lot, is that what that gamma is what drives those vertical moves, and that's just leverage and someone caught in the wrong side of a positioning, whereas the actual fundamentals, to your point about narratives, is my buddies are telling me, silver demand and all this stuff. I'm like, yeah, I get it, but that's not why silver went up $20 in a day. You know what I mean? Like, I remember the first time I ever traded silver, it was $6 total, and it was going up $20 in a day. So I'm totally with you that's the distinction between that. And why do you think, let me ask you this, you've been in the game so long, why do you think it is that it's hard for the average market participant to dissect those two things, the positioning leverage component and the fundamental component?
I don't know. I would not underestimate the average market participant now. When you live through an episode like this, you know a lot, especially if you have money in the market. You want to know about juice? Put 50 lots on. You're going to know a lot about orange juice because you have to, right? So people who are attracted to it, that survived it. I think a lot of people got, the great thing about silver, so I can't really tell, how it all comes out now. But for a period of time, I would say from the 20th of October, especially from the end last week, the Thanksgiving week of November, silver, began this sloping parabola, and in the last 8 weeks of the year, it rallied 100%. So you just had to sit there. The thing that I wrote about, and I wrote about it as early as May 2024. I started writing bullish commentary on silver in January of 2024. And my friends, we go out to lunch. I've said this before, recently, some other people, they would say, JJ, there is no shortage of silver. Like, get off it, man. And I would think, well, I think there is, and so these last 8 weeks, no one. I said so many times, you guys, readers don't understand what silver is and what it can become, because I had done the 1980s bull move, the Buffett squeeze. I traded that, I covered ICBC, then the Chinese squeeze in 2011, and every time the Reuters dealer would pop up, they'd come in, silver 2 million, silver 2 million, silver 2 million. And this is spot. So I was long in 2020 when it went up, and talk risk management gave it all back, right? So this time, I had a really good sense. This old brain was saying, be careful. And when it went down, what was it? It went down 40% in one day, right?
Yeah,
It did.
It was the last. Benny caught that top tick. My stops took me out of mine.
So no one knew how to cope with that. What do you do? If it's down 20%, your instincts are like, maybe I ought to buy some here. So that stuff is over. And now I think we're going to have a more normal, maybe a trending market that will take us above 100. But I don't know how long that will take. Like they say, you've got all the metal in the pipeline right now. How many bars is that? How many million ounces is that? And it's not so much, often I say there's no such thing as a risky asset. There's only a risky price, right? So what is this price now? We've yet to find out.
Well, we got to the stage where it was enough, which I think is your great expression. When is enough? One thing I have noticed is that the mining stocks, the silver miners, are not waiting to find out. They're carrying on. They've now pressed to new highs. Do you think we're looking at a period of sort of, metals and miner divorce? With miners doing what they do in bull markets and giving you sort of leverage and gearing to the underlying metals price?
Well, the first thing I would say is that you're not buying silver, you're buying earnings.
Yeah.
And the earnings are going to stay spectacular for quite a while. They may not, depending on, it'll track the metal for a while, but, I think there's going to come a time where the mines are going to have so much money, they're going to start buying each other.
Yeah.
And the mining stocks are really cheap to them, right? Because they need new reserves. There's probably a lot of really good, that's just great for you. You could dig into this one. Who are the best takeover candidates? Because they're going to have to do something with the cash.
Yeah. I put together a basket of miners in my note last weekend, and over half of them I put into that category of nice little bolt-ons for cashed up majors.
Yeah. Other than that, just own them.
Yeah.
I think, I urge people to stay unleveraged in especially silver, or if you're going to buy platinum, because it's very dangerous. It's very expensive to get in and get out.
Before we talk about platinum, can we go back to the big brother, to the king, as Ben likes to call it, and the gold king?
Yeah.
And I've got your compression chart as the next slide, but what is these are your charts. What is this telling you? And in particular, you focus a lot on the stochastics. Meh means a lot in my world. Again, is this suggesting to you, we're in for a bit of a consolidation here before we see?
Yeah, I see balance. In the last part of let's say in October, gold had extremely high volume for several days. Yeah. And it moved away from it, and sort of had a shallow dip lateral consolidation. And then, I think gold and silver were feeding on each other. They drew energy from one another. But gold, again, drove higher. And I think I don't know, there's no one's going to tell us really what happened, right? I mean, what happened. All we know is that when silver went down 40%, gold sold off hard as well on extremely high volume. So when you see high volume like that, what you really have to know is that the volume of sales up there have dominant location. They are up there. They have all that money. So the value of open interest at the highs was 250 billion at 5,000 an ounce. 300 either way, not a big deal. But the value of down here of the open interest in gold at 5,000 is 200 billion. So someone has 50 billion up here, and that gives them a lot of power. Unassailable, really, because we're going to have some kind of a narrative or some reason to raise another 50 billion to get back up to where we were. And it's just a very general sense of high volume on the highs and the lows, because the buyers on the lows have, anchored location. Like, I think Peter Lynch talked about that a lot. He was right. Anchored length is really a major part of every trend, because it enforces the marginal deficit of offers that's inactive, right? So he's not contributing any liquidity. So the same thing is true for the short up here. That short owns that position up there, and they're not going to contribute any buying unless it's threatened. So you're missing that from the buy side. So the longs were coming in, particularly here right now. These three sessions here.
So this is the compression chart for those following along at home.
So So let me just tell you what's going on. The high TPOs are in the middle there, where you see those three lines. I can't see what they really are, but I know from my memory they're probably between 5,075 and 4,990. So in that area, that's where I would say up to as much as 80% of all trading has occurred. And these guys up here are looking for offers, but they're not aggressive enough to go up to drive it anymore. So it's just kind of sitting there balanced, waiting for something to happen. So I don't know what's going to happen. I wouldn't buy it there.
Yeah. So JJ, what are the second, third, and fourth bars upper right quadrant there? Is this further history? Why are they on a sort of moved axis?
I'm not quite sure what you mean. You mean the little horizontal?
Sorry, I'm just talking. You've got those three pyramids on up and to the right in that chart. I was just trying to understand what that meant.
Oh, you mean those are each one of those represent one session, one day.
Okay.
Right, and you can see the construction of those. In each one of those, there's a high TPO. That's the most actively traded price in the session. That means if you were to drag those three together, I probably should have done it, but I can see it in my own mind. It's probably around 5150-ish. That is the most actively traded price. So for now, if we move away from that, let's say we roll off and go down.
Yeah.
Everybody who bought it up there, they're going to probably want to manage their risk, and we're going to come back down into this very heavily traded zone around $5,000.
Yeah.
And that we can see that for quite a while.
Yeah.
Yeah, this is at its core. It's just a volume at price chart, right? A distribution of the day. I mean, I've seen these on Bloomberg where they have each one of these little distributions over 30 days. It's kind of an interesting way to look at it, because you're really just cutting out time, right? Isn't that the bottom line of this? You're taking away the role of time in this.
all I'm doing is I'm looking where all the losers are. It's really what I want to know. You know, and when we move away from here, I know that all that trading in there, they're all going to have to either cover or sell. And
Right.
when they start doing that, that's, that's the old school way of trading.
So, in terms of the high level of open interest in gold right now, there's been a lot of commentary about there's I think people are trying to manufacturing another one of these big short type narratives. What's the easiest way to explain what is? I've got a chart here. It's not your chart, so it's a bit unfair showing it. But this has been doing the rounds on social media recently, saying that relative to history, the level of open interest in gold contracts right now is vast.
I disagree with that. I really do. I mean, nominally, the aggregate open interest is at multi-year lows. The exchange it's about 400,000. We'd have to go back to the mid-teens to find open interest that would be lower than that. But the value of the open interest is relatively high. It's actually very high. So, is there a big short in gold? Well, there obviously some kind of a mysterious short position because the BOE ran out of gold. They had 310 tons of their own, and what they might have had in third-party custody could have been, double that. And their job is to pay a yield on that gold, like tiny, but depositors put money in banks because they expect to earn something on it. And they had it all out on loan, which is what they're supposed to do, but they had, I think, multi-party hypothecation, where when everybody all of a sudden unwound their EFPs in late 2024, there was no gold. There wasn't enough gold. They couldn't get it. And so, everything went. London traded way over futures. It was easy to liquidate spot. But there was a shortage of futures. And so that, the thing people don't understand about futures is futures are really, there is no organic seller of futures. That, if you sell me spot in the normal custom of business, the mines, they mine whatever they mine every day. It's coming in various, so that, I get it, I sell a board. After a while, it's capital intensive. I'm receiving spot. I have to pay cash for that. My clients are very funny. They want credit for everything, but they want to be paid cash for their gold. Anyway, you wind up, with a big short position on the board that you have to buy back. And then you wind up with a lot of physical gold and you have to sell it to unwind. And that happens at the end of the year. Everybody, has a liquidity squeeze. So anyway, when that happened and there was a scramble and, we had this big location arb sucking all the gold and silver out of London and sending it to New York. In order to function in London, they needed to go to the BOE because all the gold was going to New York to get gold. And the BOE said, "Hey, dude, we're out of gold." So getting back, is there a short position in gold? Let me ask you this question. If the BOE needed to borrow 30 million, let's just say that's not a lot of gold, really, in the big scheme of things with central banks and everything. Why couldn't they call the Bank of France or the Germans? Why couldn't they call, Dudley at the Fed and say, "Hey, dude, I want to borrow 30 million. Just do a book entry. I'll take your gold, location London, and easy peasy." They didn't have it. No one had it. They didn't have it. This is the second part, the shoe that drops. Because they didn't have it, Musk picked it up, amplified it on X, and all of a sudden the narrative spun around. Wait a minute, what about the gold in Fort Knox? And that, caught fire in the moment. And Trump, being Trump, said, "Yeah, we're going to go to Fort Knox, and that gold better be there. We're going to be really unhappy. Not a good idea. Somebody got to Donald Trump, and they said, shh, don't do that. Shh. We don't want an audit. Not now. Shh. And all of a sudden, that just went, shh, and we never heard another word about it.
Well, you wrote a fascinating piece, JJ, saying how long it would take to actually audit it, right?
Yes.
If you had to literally assay every ingot in there, every brick in there, it's a multi-year job. It's not
2 years.
Yeah,
2 years.
It's
$50 million.
$50 million in 3 years.
Yeah.
I can tell you guys, though, I've been to the basement of the Fed, and I've seen the gold in the basement of the Fed. That was 10 years ago or something, but I have actually seen all that gold. It's quite impressive if you've never done that New York Fed tour, but there's a lot of gold down there.
Okay, so I'll there, I know there's an implied question there. Gold never goes away. We know where every ounce is since it was mined, even if it's at the bottom of the ocean. We know it's there. So, of the 7.1 billion ounces in the world right now, they do exist. But what the problem is who owns them, and leasing is almost selling. You give away the rights to the use of the metal for a return. So I think, you have to go back to the 90s when all of a sudden, central banks said, well, gold is shit. We don't need it. Let's sell it. And they sold it. From 1989 probably to 2003, Canada sold all their gold. England had 2,500
around at $400 an ounce. Yeah.
sold. And so gold went down to like $250 an ounce and stayed there for a decade, right? And then Ashani blew up in '99. That was a big event, and people started to realize, wait a minute, we've loaned all this gold out to these mines and everything. We have to start winding it back in. So now with China buying all the newly mined gold, no one really knows how much they bought, but I think it's a lot more than they say. And the Chinese people are encouraged, as a part of their culture, to do walk-in buying in the banks and use gold for long-term savings. So we ran out of gold. I don't know what's going to happen with gold. It could go up a lot.
One metal that you said has the potential to be even crazier than silver is the platinum. So if you think silver's crazy, just wait for platinum. So what are you seeing? What are you seeing in the PGMs right now, JJ?
Well, platinum has it's running a big deficit in supply demand. Cumulative, it's a couple million ounces over a 2-year period. I think we're going to have another deficit of 450,000 again this year. Those dynamics are not changing. It's rare, very useful, very beautiful in jewelry. It's, it all comes from South Africa, really, or the nearby mines in Zimbabwe. But almost all that, and Russia has some platinum, but I think 80% of it is in that one small region, hard rock, deep mining, stuff like that. So it's hypersensitive. It's politically unstable area, not much of it, very important, and we're running deficits. So in a way, it's a lot like silver, only it doesn't have the same massive ETF gamma dynamics because no one's that crazy to go in and, sell a lot of like 2-year $4,000 calls. Those would be real big boy points, if they get out of hand. So from an organic level, you can see this is platinum gold. It's way undervalued. I think it's investable. You can get bars or coins, and from a sector perspective, because silver is calming down a lot, I think the intermarket plays are going to favor platinum, where people are going to think, oh, wow, I can sell an ounce of gold and get 3 ounces of platinum. I think I'll just do that. I'll keep some gold, but give me some of that stuff. And go ahead. Sorry.
When you think about, we've covered this pretty well in the show, and the relative position of gold to oil or gold to silver, they're not stable relationships, but maybe you think of them valuable at the extremes. Like that chart's pretty extreme. It's like, it's very, very cheap relative to gold. And right now, oil is very cheap relative to gold, but whereas silver had absolutely completely ripped relative to gold near the peak.
The reason I cut the chart off from 74 was that it was illegal for you Americans to own gold before that point in time. So platinum was at a massive premium. So I cut that off the left of the chart. But it feels like platinum's half price relative to the post 74 average, right?
It's incredibly cheap.
Yeah.
I think it's, well, in terms of margin of safety, you get the highest margin of safety in platinum. You have a fundamental deficit. It's scarcity is not only, in terms of supply demand, it's in a very unstable region. 80% of it's in a very unstable region. And, Africa's Africa. I'm not saying that to be cliche,
Listen, I get it. I happen to be an African bull at the moment, but for a variety of different reasons.
Well, things tend to go sideways down there regularly. Yeah. So, anyway, so that's what I think about platinum. It's like I said, it's not the kind of thing you want to like get a whim and say, oh, let's load up, that kind of thing. But I think, if we're going to have metals in every portfolio, then that's one that should be included.
Yeah, makes a ton of sense. Now, we're going to switch gear here slightly because you've been writing a lot of really interesting stuff about crude at the moment, and I'd love your take specifically first. Your read on the stochastics here and this is WTI crude. Which contract I'm straining here as well. It's
okay. I know what I said.
Yeah.
Okay, so stochastics are, misunderstood. They are a versatile indicator where oscillating in a range of prices over a period of time, highs and lows are easy to identify, overbought, oversold. But in a trend, and I'm sure you see this a lot, the stochastics go up above 90 and they just stay there. Yeah. What that indicates is that the force of the trend is intact, and it takes a lot of buying pressure to sustain Stokes at that very high level. If you understand the way the math works, right? Because you've got this look back and you've got these moving averages, which are relatively sensitive at high prices. So the market has to keep going higher to sustain the stochastic at levels of like 90, 95. It has to be vertical to go even higher than that. So the most important thing, when you're looking at a stochastic is you have to say, am I trending? And I use DMI for that because it's the easiest, most robust indication of trend that I've ever found. So, and anybody can, I highly recommend anybody who's trading should, go to Investopedia, look at the algorithm, understand the arithmetic, what it does, why it does it. And once you do that, you're going to use it. You're going to always use it because what are we looking for? We're always looking for trends.
Absolutely. So these two why don't you just this is your standard futures setup. This is this represents about 70% of the charts in your work. Why don't you just walk through this chart, sort of indicator by indicator, and tell us what we're seeing?
Okay. Well, we'll go back a little bit, and you see a lot of red, right? So simply what the DMI says is it looks at a 10-bar sample and measures the magnitude and frequency of new highs and new lows at the same time.
Yeah.
If you have range extension down where new lows are returning a higher value than new highs, and you can have them both occurring at the same time, that will turn the bars red, and they will stay red, self-reinforcing as long as the market is trending down.
Yeah.
So I guess you can see we're down, we're trending down. There's a negative narrative. You see these little blue dots here. That's just the buyers trying to take control of the market. They have, a little bit of success, and then it turns down again. So that's kind of negative behavior. When you see a lot of red and a little bit of blue, it just means that the market is making more new lows than new highs, and it's doing it with regularly greater magnitude. Yep. When it turns blue, usually here on high volume, there was a narrative. It means that the buying has, taken control of the market, and you can see how you have successively higher highs, higher lows, without getting into the arithmetic of it, because everybody will just...
People can look that up, but
it turns blue, and you now have a trend in force, which is really self-reinforcing. The one thing I will say about this technically is there are really only two prices in trading which have any real event value. One is a new high and one is a new low. And the reason why highs and lows are so important is because they're absolute numbers. Once you have a high, it will always be the high. Or you can have a higher high, but that's the same thing, right? So the high is the high, and it will never change. The open, close, settlements, wherever your last price is, those are all random numbers. And most time-sensitive indicators use those values: last price, closing price, so forth. The high is or the low, it's the only thing you care about when you're trading, because the market can't go up unless it makes new highs. So there's that. Then there's open interest. Open interest is
the black line here. The black line here.
So the way I like to describe this is imagine commodities and stocks is like a 10-plex theater, and you have a gold movie, silver movie, copper movie, oil movie, an NVIDIA movie, and stock index movie, actually. Open interest is the number of people in the theater. So as you have, let's say, high volume, that's urgency, rising open interest, rising volume, rising open interest, blue, rising stochastics. You have all the elements of a trend there. So, these indicators combined, exchange information, they're all derivative of the same kind of activity, and they're self-reinforcing. It's a harmonious choir. It's the kind of thing that you want to be looking for, and when you see it, you're able to act.
Keep listening for those celestial voices. Absolutely. So another thing that you've been talking about is the shape of the curve right now. Yeah. And this was in your note yesterday. What is this telling you here? So this is a spread, right? First of all.
This is a butterfly. It's a June, July, August, which is like, kind of the back end of the front six. Really, most of the open interest in NYMEX is it's going to be in the front 6 months. So, this, if you're trading oil, you know this a lot, or I do because I'm an old NYMEX guy. Oil has been coming into the United States at a very steady rate since early February, since, Trump started sending ships over there. And it's been coming in at an accelerating rate. So when I see that, I'm always looking at the front of the curve, and this tells you that there's just a lot of oil coming in. Also, with the sanctioned oil, for Texas saying like maybe there's 85 million in floating storage right now, that's a lot of oil. Quite a few days of stocks of use, but it's sitting out there. And then sanctioned oil, we don't really know how much there is because it's just floating out there waiting to come into China, right? So oil is the kind of thing, once it leaves the wellhead, it has to go somewhere, right? It's got to go into a pipe. And once it's in the pipe, it's going to move through the pipe. It's going to go into a ship, and then it's going to sit out there. And if you don't have a buyer for it right away, that ship's going to stay on the seas, right? Until somehow it can get, washed and find its way to shore. So either that or it'll go to China, but China can only take so much at a given time. So I don't know how much oil's out there. Maybe I just don't even want to guess. Maybe it's 150 million barrels. That's a lot. So on Wednesday, the DOE reported a 16 million build in Pad 3, which is the Gulf, which is the heart of our refining sector. And they also reported that capacity utilization refining capacity dropped to 88%, which is kind of low.
Here are the crack spreads. I mean, it's something as someone who's long the refiners right here. This has been an unexpected gift.
Cheap crude is essential to refiners making money, right? Relatively cheap crude, right?
Yeah.
So gasoline, I don't know.
They still need someone to buy the product, though, right?
Right.
It needs both.
Yeah. So go back to that fly for a second. I'll tell you what it means. When you have too much oil, I mean, you have to remember oil's coming through all the time. It's like a river and so forth. But when I receive oil, and if I'm getting too much oil, I'm going to lend it, right? I have to lend it. I can't just let it sit there, and I don't have anybody. I'm not making enough products downstream to refine it. So how do I lend? It's a repo. I just sell April, I buy May, or depending on what my refining schedule is, I will sell April and May and buy June and July. And so, when that happens, and everybody is, it's just kind of like a soggy situation now. Everybody has too much oil because I think Trump is bringing it in, or he's creating an environment where oil has to go somewhere, and it's coming here, and as we're receiving it, the guys who have it have to lend it. And that puts
this is an Iran Straits of Hormuz hedge, if you like. I mean, that's the narrative behind bringing it in now, right?
Like I said, it's got to go somewhere, and it's coming here, and it's coming. I mean, Russia's discounting $12 a barrel now, so China's like saying that's great, but they can only take so much. I think it puts pressure. The sanctions are an epidemic backfire, no matter how you look at them, because the marginal barrel is the illegal barrel. And as long as you force prices down like that, it drags the whole system gets pulled down with it, especially when you have two producers like Russia and Iran who are pumping a lot of oil. And so anyway, the excess oil, wherever it is, in the ship, in the pipe, in the tank, in the loop, or China or whatever, the excess oil is going to get lent, which is a repo, sell the front, buy the back. And that pushes pressure on the spreads. Okay, so let's go to the cracks. So cheap oil makes it easy for refiners to make a lot of money, right?
Yeah.
And That's what you're seeing now. I know since you're long them, they had a killer fourth quarter.
Yeah.
PSX and Marathon, all those companies, they made a lot of money, and that's that crack. So when Trump started, banging the drum about bombing Iran, crude rocketed higher, and the cracks crashed. Right. But now, with all the oil in the market, crude is cheap again, and so you've got high cracks.
What's interesting is that the refiners continue to do quite well, even with the crack spread falling. I'm talking about the equities here, but there's three inputs to the 3-2-1 crack spread, right? Ultimately, if there's a lot of cheap crude around, you still need customers for the diesel and the gasoline, right? And so, because otherwise those inputs to the formula will come down as well.
Well, what they'll do is what they're doing now. They'll lend their excess crude in the market as long as it's back, right? It's great. Here, I'll sell you all the April you want, and I'll buy May and June cheaper, right?
Yeah.
I'm selling April here. I buy May and June down here. I can afford to sit around. And downstream, they're putting pressure on the front of the curve. They're putting pressure on oil. They're still selling. I don't know what all product supply are doing right now, but it's a steady 21 million a day that they're selling into the United States, and there it is.
Yeah. Brilliant. Well, I don't think. I think it's a hiding to nothing trying to predict what happens next in the Middle East. I don't even think the people making the decisions know. Go on, Benny.
I just hope we can wait 3 days. I got 48 hours left in the Middle East, so we can just wait 3 days. I'll get the hell out of here. I'll be very happy. But let me switch gears a little bit, JJ, since we got you. We're getting close to the hour. My father sent me down to the Chicago Mercantile Exchange when I was a young buck in college to work in the Eurodollar pit. And, those days are gone. But can you give a couple good stories or one good story about the pit and like the actual being there amongst the guys doing the signals and guys, just give some good war story. And because it's a different time of the world. And it's just like for a guy who's been there so long, I'd be super interested to hear.
Well, I guess, on January 9th, 1991, Tricazes and James Baker were meeting in Geneva, very much like we had today. The mood of the market was there was a lot more tension because Saddam had already set Kuwait on fire, and he was moving aggressively towards Saudi Arabia. And Baker was saying, hey, dude, don't do this, Don't put us in a position where we have to go to war with you. And they said, hey, we're not worried about you. We're gonna do what we want to do, because, as I understand, in those days, Bush 1 had told Saddam, don't worry, we're not gonna interdict any type of military activity. But I don't think he thought they were going to go set all the oil wells on fire and start killing everybody. At any rate, when Baker came out in the afternoon saying, regrettably, these guys are not willing to negotiate anything, crude rallied like 30% in 5 minutes. The phones are all trying to buy it.
Wow.
This is, everybody's sitting there like, what do we do?
Did you have a position?
What?
Did you have a position at the time?
No. I had a lot of unhappy customers. Really, it was a really rough day. At any rate, what I wrote about this, and I think what Trump is doing, if you can imagine, you want to know what it's like in the pit. It's crazy. You got 300 guys that are screaming and yelling at each other trying to get something to buy, and the spreads are $5 wide for a barrel of crude. You decide. What are you going to do? At any rate, it has been the official policy of Western governments during periods of military action to sell gold, support equities, buffer volatility, to deny the bad actors that kind of market response, which is actually a type of financial weaponry. And they become really very good at it. It's not the same thing as the BOJ, polishing the
Price.
dollar yen. It's brute force stuff. And in order to achieve what I think Trump wants to achieve, which is not to allow crude to go, up 20, 30%, he started early. KSA is beginning to ramp up production. They're talking about increasing OPEC production. And there's I would say there's more dissembling. I won't say, dishonesty in crude than any other market. They're all, everybody's telling you something that you just can't believe. I think there's a tremendous amount of capacity to produce crude quickly. The reason why they don't want to do it is once you start doing it, it's very hard to stop.
Yeah.
Right. So all that crude that's coming out now, you have to, in your mind, if you're thinking about crude, think of 1,000 ships going from the Loop to Ras Tanura, right? Maybe not 1,000, it could be 500, and 500 going back like this. If they wanted to move a lot of crude, that's what it used to be. Now Saudis don't sell so much here, and we're exporting 5 million a day or 4.5. So at any rate, every day, if you have us exporting 4.5 million, and a boat's 500,000, so we got 8 ships leaving, and it's others going. Ships all over the world carrying oil. There's just you can't stop it. It's going to keep going. So if they raise production, it's going to take time to bring it back, and we're going to have an awful lot of oil.
I mean, Trump wants lower oil, though. I mean, I've maintained that, since he's come in, the rally that we've had since Liberation Day was oil suppression and dollar suppression and volatility suppression. And, the U.S. market's a little fragile, the consumer. And so, if we had higher oil prices, it would be a real issue. So I think that's kind of the policy, don't you, from this administration?
Yeah, they want oil prices lower.
Yeah,
and the Trump, he's in a position now to make all kinds of deals. He's got the United States Navy sitting there, one of the most powerful forces ever in the history of man, and he has the ability to say, "Okay, we're gonna bomb Iran." So a lot of people would like that to happen. Saudi Arabia wouldn't mind it at all if Iran went away, because now we have Venezuela coming back, right?
yeah.
And sooner or later we're going to make peace in Russia, and all that oil, that sanctioned oil floating around out there is going to be legal. Putin will go back to pumping oil. He's happy at 40. He was happy at 40 in March 2020. I think he's happy at 40 now. We are the largest producer of oil in the world in the United States. And we're with condensates and what we're producing in the Permian and Exxon's new find down in Guyana and so forth. Canada's going to run. They say they want to, increase their production. I don't know if they will or they won't. It's hard in Canada, but they're doing a lot of oil. Saudis aren't going to get left behind. I mean, I don't think OPEC really exists anymore. It's a handful of producers in OPEC now. Angola's, pretty much out of it. All the marginal guys, I don't know how they're going to do if we get oil down to 50 or 40 or something like that. That could be the strategy. Put some of the weaker players out, replace them with strong players. That's long cycle stuff. We're going forward in over years. Right now, we've got this thing, and the Iranian thing, rather than restricting oil, I personally think is increasing the supply.
Interesting. Listen, JJ, this has been a real treat. Thank you so much indeed for joining us. I would urge everybody who doesn't already do it to subscribe to your Market Vibes on Substack. There will be a link to that in the show notes. Not only does JJ bring just so much knowledge and wealth of experience around all of these commodity markets, but he writes utterly beautifully. And his short stories are a treat, and I just absolutely love them. I read your notes first thing in the morning and last thing at night, and I love every one of them. So thank you so much for joining us on the show. It's been a huge pleasure.
Thank you, Rupert. Thank you, Benny.
Thank you.
Real
We appreciate
pleasure.
it. It was a lot of fun.
Yes, sir. Yes, sir.
Benny, the Squirrel, and JJ out.
See you guys.